welcome back guys to another video. This is Karan here. The rates are touching 8% and there's no immediate signs of the Fed indicating that they will be bringing these rates down. Now, despite all of this happening, there are still active buyers like yourself looking for a deal or are actively in a contract right now buying houses. So in today's video, I'm going to share with you what is the best loan program if you're looking for a lower monthly mortgage payment. It is critical, more critical than ever before, that you have the right information, because right now it is a game of inches where the rates are touching 8% and a little payment difference can throw the numbers off whack where you can get disqualified and won't qualify for a loan, or the numbers are so high where you're just not comfortable with that payment. So the purpose of today's video is to show you simplified information and tell you which program you should utilize, you should use right now in today's market. So you definitely want to stay till the end. Like I mentioned, the purpose of this video is simplicity and clear information for you. So we're not going to talk about every single loan program out there that's available. There's tons of them out there. We're going to primarily focus on good first-time buyer, let me rephrase that, great first-time buyer programs that will help you lower your monthly mortgage payment. So the two main loan programs that we're going to talk about today are going to be the FHA loan and the conventional loan. Before we dive in and look at a real-time scenario for a conventional and an FHA loan, let's look at some basic loan requirements and give you guys a refresher course for those of you that are already in the market, and maybe new information for first-time buyers that are just tapping into this market. So if you're looking to get an FHA loan, the minimum requirements are: first, down payment, minimum required is 3.5% down. Credit score requirement 580. FHA will and can go down to 500 if you're able to put 10% down. DTI, which stands for debt to income, FHA will go up to 57%, meaning that you can qualify for more of a home with the FHA loan as compared to a conventional loan. FHA has just released a new guideline that allows you now to take ADU income. So what that means is if you're buying a house and there is an additional dwelling unit in the backyard, or if there's a garage that's converted into a rental unit, which has to be in code with the city. I won't go too much deeper into this topic here, but just to throw this out there that FHA is allowing use proposed income for ADU units. All that's doing is, or what that's doing for you is, it allows you to just qualify for more. So this is a new guideline. If you're not familiar with this, there will be more information on it, but this is already in effect. Now, the conventional loan, down payment requirements for the conventional loan is minimum 5% down. There are other programs under the conventional guidelines that allow 1%, 3%. We're not talking about those today. We're talking about the ones that offer you the best terms and the best mortgage payment. So let's stick to the 5%. Credit score requirement is a minimum of 620. DTI, again, debt to income ratio, we can go up to 50%. In some cases, it might even be lower. It's gonna depend once your numbers are run. So these numbers that I'm giving you are basic general guidelines. They may and may not fully apply to you depending on your credit score, your income, down payment, all that good stuff. But these are general requirements. As you can see when you compare both, that the FHA has lenient requirements when it comes to the down payment and also the credit score requirements. Now we're ready to run a live scenario on the board here for you so you can see which loan program offers you the best monthly mortgage payment. Before I do that, I want to let you guys know really quickly, for those of you that don't know, that anytime you put less than 20% down, the lender will charge you mortgage insurance. Now on the FHA side, it's called PMI, premium mortgage insurance. On the conventional side, it's called mortgage insurance. Essentially, they are the same. They're not the same as far as how much that program is charging you, but the functionality of it is the same. It means that if you're putting less than 20% down, it's a riskier transaction for the lender. So the lender is asking you to get a monthly mortgage insurance that will cover the lender in case something were to happen if you were to default. So anytime you put less than 20% down, you're gonna have mortgage insurance. If you're looking for a more in-depth analysis and more loan requirements for the FHA and conventional mortgage, please click on the link above. So let's get going. So we're gonna look at scenario number one, and in this scenario, we're gonna first look at the conventional mortgage, and we're looking at a purchase price of $750. Now this may work in your area, it may not work in your area, but I wanted to pick an amount that sort of maybe translate through a lot of different markets in the country. So purchase price is going to be $750, and we're going with 5% down, and that is $37,500. which makes your loan amount $712,500. Then you have a credit score, let's say for example, for scenario 1, at 750, your rate on the conventional mortgage will be 8.125%. And remember, we're running this today. Today is October 25th, 2023. Rates change daily depending on when you're watching this. So let's keep moving. Mortgage insurance on this, like I had mentioned earlier, you're putting less than 20% down, you're gonna have mortgage insurance. So mortgage insurance on this conventional scenario is gonna be $172.19. Your total monthly mortgage payment, not including taxes and insurance, because taxes may be different in each state, so I'm not including that here. So we can just do straight apples to apples comparison. Your mortgage payment is gonna be $5,462.48. That is for a conventional loan with 5% down at 750 purchase price. Now, moving forward, under the same scenario, but under the FHA program. If you were to do this under the FHA program, purchase price is gonna be $750, down payment 5%, same down payment, even though you can go lower to go to 3.5, but for comparison purposes, we're sticking to the 5%. It's gonna be $37,500. Loan amount is gonna be $724,968.75. Just hang out with me. Why you might be thinking, why is the loan amount a little higher from the conventional? It's because FHA also charges you something called an upfront MI, upfront mortgage insurance, which is 1.75% of your original loan amount. It's only a one-time charge, which can be financed into the loan. You don't have to pay for it upfront, and in this case, it is being financed. That's why you're seeing a loan amount of $724,968.75. Now, credit score is the same, 750. Your rate is going to be 7.230. PMI is going to be $295.97. Your monthly mortgage payment on this one is going to be $5,231.30. Now, if you compare both of the mortgage payments side by side, the conventional and FHA, you can see here that there are savings of $231.18 if you were to use the FHA loan. If you're getting real value out of this video, don't forget to subscribe to my channel. Let me know how I'm doing by leaving me a comment, and don't forget to smash that like button, because more people like yourselves will be shown this video that need to watch this video. Thank you for watching. Moving on to scenario number 2. Again, we're gonna look at a conventional mortgage and an FHA mortgage. So starting with the conventional mortgage, we're gonna stick to the same parameters, same purchase price, same down payment, but now we're gonna change your guys' credit score. Say if you had a credit score of 680, what would your rate be? Your rate would be 8.424%, mortgage insurance of $362.19. Total mortgage payment on the conventional side would be $5,802.37. Now looking at the FHA scenario, again, same purchase price of $750, same down payment, but a credit score of 680. What happens? Rate is still the same, 7.230%. Mortgage insurance is the same, $295.97, which gives you a total payment of $5,231.30. Now, if you compare both of these payments side by side, you'll notice that you're saving $571.07. That's a drastic saving there, guys. So as you can see here, clearly the winner is the FHA loan when it comes to having a lower monthly payment. Even when your rates went down from 750 to 680, the FHA had a very low, practically no sensitivity to that, where nothing changed. The rate was the same, the PMI was exactly the same, but the conventional loan was a lot more sensitive to that, and your mortgage insurance went up, and so did your rate. I don't like to sugarcoat things. My goal here is to provide you clarity, so I would like to talk about the goods and the bads. As we saw, the FHA loan is a great program to lower your monthly mortgage payment, has a lower monthly mortgage payment than the conventional program in the scenario that we just ran, but I also want to talk about the bads. So, number one, the premium mortgage insurance that's being charged on the FHA will stay on the loan for the life of the loan until you refinance out of the mortgage. Number two, upfront MI, upfront mortgage insurance that was charged one time, the 1.75% that I talked about earlier, will be charged every time you get an FHA loan. It's a one-time charge, but the conventional does not charge you that, the FHA program does. So you could either finance it, which most people do on the loan, or you can pay for it up front. In our case, at that $750 purchase price, the finance charge was about $12,000. So that got added on to your base loan amount. Now, if you're having this loan and you're looking at the payments on a 30-year amortization cycle, it may not make a big difference because you're also having house appreciation year over year. But if you looked at it on paper, yeah, you're adding that on top of your loan, but it's still adding that on top of your loan. You saw clearly the monthly mortgage payment was still lower than the conventional because the rate on the FHA was so much better. And the mortgage insurance didn't change much on the second scenario. Number 3, doesn't matter if you put 10% down, 15% down, 20% down, 30% down, the FHA loan will always have the finance charge and it will always have the monthly premium, the monthly mortgage insurance that you will be paying on the life of the loan. If you are a person that has more than 20% down, it might be a great idea to do the conventional loan. Now, if all of this is sounding very confusing and you're tapping in the market and you want more information, you want to run a personal scenario, click on the link in my description to get connected with me, and we will run a personal scenario for you that will help you understand which program is better for you. The mortgage interest rates and the market in general is out of our immediate control. What we can control is saving money, not getting more liabilities, running your numbers with a loan professional and knowing what your numbers are, and also staying aware and keeping your eyes, ears open to know what's happening in your market and looking for opportunities. Now, the Federal Reserve is doing this by design, as I said earlier, and their target is price stability in this country, and they will continue to do whatever they need to do until they have that. So if you want more information on that and want to know why the Federal Reserve is doing this and how they're bringing rates up to bring price stability, click on this video. That's all I have for today, guys. I hope this video was insightful. Until next time, this is Karan Singh.